Robschild, no investment advice. Welcome to a special edition where we're going to take a look at the earnings and valuation of Walmart. First, we should go over the basics. A stock is a piece of ownership of a company. A company makes money. You own those earnings. When you own a stock, you're owning it because of the earnings that the company makes. Once it's done paying for the materials, the labor, the CEO, the taxes, the leftovers belong to the owners of the company, who are the stockholders. If you've been following my daily show, I've been getting a little crazy about the valuations of stocks in general, and I just wanted to provide a special edition to kind of back up what I'm talking about. I've shown this chart before. This is the S&P 500 earnings, a 90-year historical chart. This is macrotrends.net. You can find this chart for yourself. This gives monthly updates. I think in a previous video I said it's quarterly updates, but it's actually monthly. The most recent reading of this, if you scroll all the way to the end, shows April. If you scroll in, I thought I got squeezed May in there too. There it is, May 2024. EPS of, as you can see right on the screen, of the S&P 500 was 191.79. Now this orange line here that you see is the earnings per share of the entire S&P 500. And as you can see, it was higher at the end of 2021 and the beginning of 2022, around 197, and we're actually lower right now in earnings per share. Now, if the company that you own is earning less money, it would make sense for the value of that company to be less. That's very simple. It's very easy to understand this. Yet the price of the S&P 500 is at basically all-time highs. The math doesn't check out here. Granted, there are periods where the stock market, the blue line, is the price of the S&P 500. There are times where the S&P 500 gets ahead of the earnings. It sniffs out the increase of earnings ahead of time, which is why it can raise itself in price. So it's possible that earnings will be going up here to follow the price of the S&P 500. But they are very dangerous waters. And why I say this is because if you don't get the expected earnings growth, or you even get earnings contraction where earnings are going down, then the stock market is wrong, and that's when you can have major bear markets. Scrolling out, very notably, the earnings, the total amount of money that the S&P 500 makes as a business. If it was one business, in 2000 it was making $53 per share of the S&P 500. It dropped to around 24, around 25 throughout the dot-com bust. This was a major contraction of earnings per share, making the value of the S&P 500 not worth as much as it was before. It's just very obvious. And actually, the earnings per share bottomed and ended up starting an uptrend, while the S&P 500 actually continued lower in price. And so the point here is sometimes earnings will follow the price of the S&P 500, and sometimes it's the other way around. Sometimes the S&P 500 will follow what the earnings do. So when we had a peak in 2007 and earnings contracted sharply and then sharply down even further, that's when the stock market was like, uh-oh, and then everything crashed together. We bottomed with earnings per share of the S&P 500 in 2008 of earning only $7 and what's the bottom here, $6.86 per share of the S&P 500 briefly in March of 2009, equal to, let's see, it's not even, you have to scroll out pretty far to get that low in earnings per share. So companies were on an intrinsic value, if you're owning a company that's only earning $6 a share, then the price better be pretty low too. Now, granted, over time, everything pretty much just always inevitably goes up, especially because the US dollar is a fiat currency and is, constantly expanding. But very notably, the point here is that earnings can and do contract, making the actual value of shares less attractive. When you own a company and it's earning less money, it becomes less attractive to buy it for the previous price, right? If the amount of money it's making is going down, it makes sense for the value of the business to go down. And today, in 2024, at least as of May, we have experienced not higher earnings per share of the S&P 500, yet the price of the S&P 500 has somehow gone up. I wanted to extend this idea further by just digging into what I think of as like bread and butter company of the United States. Like, I shop at Walmart myself all the time. I probably go there at least once a week, if not more than that. I just heard a recent statistic that $1 out of every $12 that people spend in stores is at Walmart. So it's a massive company, and I want to walk through a little valuation exercise with Walmart. You can find the numbers yourself. You can walk through the same exercise that I'm doing if you want. This is macrotrends.net, Walmart earnings per share. So we're going to just take a look at the earnings per share from 2010 to 2024. Now, this is a trailing 12 months, so each one of these represents the last 12 months of earnings. The beginning of this chart is around 2009 going to about 2024. Now, as you can see, we were pretty sturdy if we take a look at the date up through about 2016, 2017, before we started collapsing a little bit, expanding a little bit, collapsing, expanding. But how does all of this average out? What I wanted to do was kind of split this into two segments here. The beginning of the 2010s and then the end of the 2010s through where we are today in 2024. So we're going to split this down the middle around 2017, and we're going to average the earnings. So all I did was I took from 2017 to 2024. This is before it started dipping and going higher, dipping and going higher. This is during that period when it was flat and then it dipped and then went higher, dipped and went higher. So the average from yearly EPS from 2017 to 2024 is $1.45 per share. And then from 2009, basically after the Great Financial Crisis, notably this is not like a super low or negative number in 2009, $1.13. 2009 through 2016, what's the average? $1.49. So the first half of this time period earned $1.49. The second half, $1.45. This is a contraction in the amount of money that this company is able to make. All right, and if you own Walmart stock, you own a company that now makes less money for the past, 6, 7, 8, 9 years than the previous 8 or 9 years. So by that metric alone, the price of Walmart shares should probably be a little bit cheaper than it was back in 2009 to 2015. I'm going to add to this equation that when rates are higher, when interest rates are higher, there's a greater return that you can get in bonds, in money market accounts. This makes the cost of business higher. It makes it harder for companies to earn as much money. And so we're not looking. The Fed right now has been very restrictive now for 2 years and is purposefully trying to make the earnings shrink of these companies. it's not trying to let them grow from today moving forward. They want contraction because they don't want inflation to continue to get out of control. Not only that, as an investor yourself, to add to the whole mess of the equation, you have the option to have your money sitting in a risk-free money market account paying you a 5% return versus what it was in that time period, which was a little bit less. So every which way you put it, the shares of Walmart should be, I would suggest, significantly lower than what they are today. Granted, yes, the earnings will likely expand over a longer time horizon, but just looking at these two periods tells a pretty interesting story. So let's take a look at the price now. Now remember, from 2009 to 2016, this company was making more money on average than the past 7 or 8 years. So what do we have for price? Well, in 2009, we were at $15 a share. Looks like going up through 2014, we got up to $27 a share, peaked out at around $30 a share, went back down to $20 a share. All right, and that's 2016. So the highest this ever was around $30 a share. And seeing as though right now the company's actually been making less money since 2016 and 17, well, $30 per share is actually pretty expensive for a price as far as I can tell. But let's see what happens to the price instead. So remember, $30 in 2015. All right, so 2017, all right, $30. Oh, $36 in 2018. Maybe it got ahead of itself. Maybe it'll cool off a little bit here and go down a little bit. No, not really. Now we're at $50, so double the price that it was. That's a little crazy. Double the price for a company that makes less money than it did for those 6 years ago. And now today at $77, this is over triple the price. Would you pay 3 times the price for a business that is making less money than it did from 8 years ago to about 16 years ago to what it's making in the past 8 years? Would you pay 3 times the price for that? This is one of the reasons that I'm sounding the alarm bell saying that stocks are overvalued here. You know, remember, Walmart's not like a super risky business. This is a household consumer staple business that does a heck of a lot of business. This isn't like a massive speculative growth stock, and yet the valuation, it seems really expensive to me. There's no other way for me to put it. And when I say that there may be coming an 80% or more correction or downfall in the price of the S&P 500, I'm not kidding. I think that is very possible, and this is just one of many examples that you can check out and go through yourself. Again, a stock is nothing more than the ownership of a company. If companies aren't making as much money, then the value, for the value to be higher than it was when it was making more money, it doesn't make sense. A business person wouldn't go for this. This is not an attractive valuation. This is not an attractive market. This is expensive. That's all. Hope you enjoyed. Thank you for watching. Robschild.